Okay, so it's 9 o'clock, so I guess we can start. Thanks for doing this,
Yeah,
Ankit, on super duper short notice. Really do appreciate you taking the time on a Karwa Chauth evening in India. Obviously, you're not in India, so I guess
Yeah,
that kind of explains it.
yeah,
Um,
yeah. No, thanks. The pleasure is mine. And yes, you're right. Since I'm here, it's easier for me to do it on an evening of Karwa Chauth. So otherwise, would have been hard. But yeah,
yeah, to all the married men who are right now here on Twitter and women who are here on Twitter and living in this particular space and living in India, kudos to you for wrapping up your Karwa Chauth. Or if you forgot about Karwa Chauth, here's a reminder. But just don't leave this space just yet because we have a lot of interesting things we're going to talk about with Ankit. Um, so yeah, again, thanks for doing this, man. Let's, I guess, just start with an intro. I remember when I first spoke to you, it wasn't that long ago. It was actually just a month ago. And one one thing that I've noticed every time I've had a conversation with Ankit, no matter how small the conversation um, tends to start off with, like it could just start with like a single thing that I wanted to discuss with him. It eventually morphs into a multi-hour conversation. So talking to Ankit on the phone tends to be a time sink, and I think that has to do with more so just how both of us are interested in what each of each of us is doing, and also because the very strong intersect between between us in terms of trading, where he's super passionate about trading and building out whatever he's building out as part of Decibel, and we're trying to do something similar with AlgoTest over here. So it's always a great pleasure to have a conversation with him, and I call it a time sink, but it's not really a time sink because I always walk out learning something or the other from him. So Ankit, he started off, um, or from what I remember from our first conversation, as a systematic trader, you started off in Forex and you've seen some pretty crazy drawdowns. I'd love to hear, and I guess the audience would also, love to hear about the beginning of your journey. You are the eponymous Ankit Quant now in Twitter with a significant following, but we'd love to hear about how you started.
yeah, sure. So thanks for your introduction, Raghav. So I guess our first conversation was not a month ago. It was probably a couple of months ago when it was the first long call that you're talking about. But yeah, uh, appreciate all your comments. About my journey, I did not start as a systematic trader. Actually, I started off as a manual discretionary trader. I was in India, so I have an undergrad in computer science engineering. So after that, I had the opportunity to work with some of the largest banks in India on their forex trading desks. So I was actually a voice market maker. So for those who may not understand, in today's world, the voice market makers are no more existent in at least in the FX market. Dealers are very tiny bit. But back then in India, I think they're still doing it. But globally, the markets have moved more electronic. So we were running banks books. We would have so FX is traded in what they call as interbank market. So essentially, banks are trading with other banks. The retail market is, it's an OTC market. So what you see in retail FX globally is some brokers who have tied up with the banks as liquidity providers to give you a smaller ticket size. Because at a bank level, the typical sizes are $500,000, $1 million, or equivalent worth of trades in a given go. So I was a market maker and FX voice market maker in Indian rupee, dollar rupee market, and crosses as what they call it, Euro INR and dollar INR, Euro INR, Yen INR, or Pound INR, and so on and so forth. So I was working there. Uh, I did that for a couple of years. That was really um, me starting out of college, undergrad school, landing a job at a trading desk, uh, completely being enamored by the first day I stepped into the dealing room, as they call it. It was in Bombay. Uh, it was like as I used to call it, it was like a child in a candy store. I was very happy. And I was always entrepreneurial back then as well. So it was within, I would say, within first 2 years itself, I quit my job and I started an FX trading, managed account trading business, sitting in India. Uh, as the luck may have it, being underprepared, the young blood being rushing into things, I realized how difficult it is in India to remit money outside India to trade FX, because there were not a lot of FX brokers in India. I don't know if anybody has been uh, anybody has been aware of some of the erstwhile FX brokers who tried to set up shops in India. One of them was Alpari UK. So they were a big UK FX broker. They came to India. They were setting shop, and then um, the RBI guidelines are such that they prohibit outward remittances to margin trading. So that's why even right now you cannot trade on margin on international exchanges. And I did not know it back then before I quit my job. But nonetheless, I was able to raise some money outside India. I had a managed account trading setup. I used to trade looking at the charts. I had a system, I still remember it. I used to run it on a 15-minute basis, candlestick basis. I had a few indicators, very few indicators, a price action based. But FX market is a 24-hour market. Uh, Me and then I actually had another partner with me, so he and I would jointly trade. And there was this one time he put on a silver trade, and he kept on averaging it until it blew up on our face. I think we lost on a single trade about 25-30%. It was such a shitty way of managing a trade. Nah, I kind of ended up firing that guy for his lousy risk management and started trading on myself. Recovered most of that money, I think, but it took a toll on me because I was under so much pressure. I was just starting out. I was a young guy, did not have a systematic system. I mean, I did not have a coded system. It was discretionary manual trading. Uh, I I made most of it back. I think nobody of my clients lost more than 5% over the course of whatever in a year or so I ran that program. And then I returned the money and I said, there is a lot for me to learn. My knowledge is not there to really take this up, scale this up. So I went back to industry, worked for a while in India again, in a FX dealing trading role only, but slightly on the other side, where now I was more on advising clients and for their FX trades and whatnot. But I was still working for a bank. Um, and then I moved to US. I went for my program called financial engineering, or quant finance as they call it. That's why the name says quant. That was my first time foray into understanding that there is another side of how the markets are viewed at. Uh, Statistical side or stochastic calculus side, and slightly more technical, actually much larger technical skills were required to do at least clear the program. uh, it took me a while to really pivot myself because I came from a background in which we used to read charts and look, seeing, market kya lagta hai sort of a thing, right? That kind of the background. And from there, getting educated with people who were actually Nobel laureates or, professors who were nominated for Nobels, so it was a very paradigm shift for me to understand, kind of upgrade my skill set, so to say. And then since then, I've been in US. It's been close to 10 years. I've worked across banks and hedge funds in various roles, in trading roles, in risk roles, uh, depending on in my different career paths. And then uh, just around COVID, after COVID, I started Decibel Capital, which is right now focused on Indian markets. We have a crypto book as well, small, very small. That's my personal book actually. But most of the work we do with Decibel Capital is in Indian markets, wherein it's now fully automated, fully systematic, algorithmic trading. So I take care of um, the research part, um, most of it. Technology part is also, I have a partner who works with me. Uh, so they take care of the execution part, but then I'm also equally involved. So as a company, Decibel Capital is trying to systemize, offer these algos as you call it, and looking to expand it beyond uh, what we've started with. So that's kind of my background. I'm not sure if it was too long.
No, it was great, man. It, yeah, gives me a lot of context for my follow-up question. This is I'm gonna do a bit of rewind on your intro and sort of ask you that you started off as a sort of a market maker, right? In the FX space, working for a bank in India, and then you made that initial transition from a market maker to essentially somebody who's trading using charts. So so first of all, like, who were you trading against as a market maker? I'm actually not familiar with the FX side of things at all, the OTC side at all. So I'd love to hear that. And secondly, the sort of transition of going from a market maker to, say, sort of like a market taker, where like a market maker is usually like a word for a colloquial term for market maker in India is operator, right? Where you
Yeah.
are essentially providing you're ready to buy and you're ready
Liquidity.
to sell. हाँ, तो
Yeah.
अब operator से operator भैया के like, how did you succumb to the vagaries of operator भैया and decide that, hey, I can probably trade this as a market taker?
Right. So, very interesting and deep question. The answer will be long. Uh, so, on the role in India, or even, if you think, I did the market making role at a bank in US as well, by the way. That only difference being in India, I was a voice kind of a market maker. In US, it was electronic and, quantitative systematic market making. Uh, first I'll talk about the Indian market. So Indian markets, so the way the interbank market is structured, like I said, is the banks dealing with banks, right? Until then, when I started, the NSE futures were not launched, or they were just about being launched in a couple of years. I don't remember the exact timeline. So this was way back in 2007. So I think NSE launched in 2010, if I'm not wrong, the currency futures. Until then, there were no currency futures. So think about who needs to be. So who are the clients of the banks? These were these big corporates who had forex exposure. So, for example, rice exporter or sandalwood exporter, or let's say your tech services, like tech companies like TCS and Infosys, what might not, who have their dollar remittances coming in, like they bill their clients in dollars and they need to bring it in India to pay salaries and costs and profits, whatever might you. And then the other side are the exporters who are selling their products outside, or the importers, sorry, wherein they're buying something for India, like you're importing oil or you're importing any other kind of rare metal or whatever might be, and paying it in dollars. So these are the technically the clients of the banks, right? So they usually have agreements with different banks to hedge their exposures, or whatever have you. I don't want to get into details on that side. So now what that leads to is this interbank market, wherein all these different big banks, they provide these services to the clients, but then they also need to hedge out. So banks do not carry these exposures on their books, right? So all they want to do is, let's say XYZ corporate bought 1 million US dollars from us, we'll go and hedge it out in the market, right? So now this is what they call as flow trading, not floor, like it's the flow that you are seeing the flow. A corporate is coming and buying from you, and then you are either holding on to that risk for a while, maybe half an hour, 30 minutes, an hour, or you're hedging it out right away. So there used to be these dealers who would face the clients, and whose job was to make these clients trade, or hedge out their exposure, sell them structures. That's the sell side, typical sell side business the bank is in, right? And then we were the interbank guys, so we were the ones who were dealing with other banks. So we will make markets for other banks. So a bank X, another bank will come and ping us, hey, what's the USD INR right now? So you can, uh, the interbank market runs on Reuters systems. So there is a Reuters matching system in which you can put your quotes, just like you can put your limit orders in markets, and it goes on an exchange. So Reuters kind of works as an offline exchange, but since it's an OTC market, it's not a centrally clearing exchange. So what that means is they are just providing you a platform wherein FX buyers and sellers can come and match their bids and asks, but then they are not the central authority. You can as well be doing it anywhere else. Unlike NSE, wherein every trade has to go through a central exchange, right? So the regulations are much more strict for equity markets as compared to the FX markets. So I was when he started, I was on that desk which made markets on Reuters or other banks. So we were quoting to other banks, two-way markets if needed, one-way market if they ask for, and then putting our bids and asks on the Reuters, depending on where we are seeing the flow, where we are seeing the market, how much inventory we are holding, so on and so forth. So it was electron. And then, of course, you would have these brokers who would call in, or other banks can also ping you. So, so it was electronic slash voice in a way. So our counterparts, so we were making markets two ways. We were making markets for our interbank counterparts, either other banks or other corporates. And on the other side, internally, wherein with these sales guys who would go and talk to corporates and, would need another price to show, show a market, as we call it. So, yeah, I mean, that's how it was in India. I don't know if
Yeah,
that answers
super.
the question.
No, dude, super interesting. I think the idea behind so first of all, it's really good to understand from first principles who actually needs these derivatives, right? I mean, we are here trading. Lots of people are now entering the markets, and to them, Nifty and Bank Nifty is kind of an abstraction. It's things moving, like it's prices in a chart essentially, and options are that as well. But when you started this answer, you started with it's essentially importers and exporters whose currency
Yeah,
exposure, who want to sort of hedge out their currency exposure. If I'm an exporter, I'm interested in selling whatever I've manufactured or procured outside of the country, and I don't want to be subject to the vagaries of currency fluctuations that can happen. So in order to do that, I would come to somebody like you and try and figure out a way to hedge out that exposure so that I can actually focus on the
right.
core of my business, which is manufacturing or procuring something from my home country and exporting it outside, and vice versa case for the importers. So it's actually really interesting to see that there is there is a connection between the real world and sort of the financial world. And the financial world initially was created to try and solve these very real world problems. So that was actually super interesting to hear. And secondly, I'm again, like, we're going a little bit deeper here, and I guess that has to do a little bit with my background in market making as well. I'm super curious to understand, like, you had sort of like as a market maker, you had a hybrid system, you said, right? It's part electronic through the Reuters terminal, and part it was kind of voice driven through, like, I don't know, phone calls or on the floor or something. So the question here would be, what was the like, what kind of a model did you guys have to actually manage the flow that you said that decided your bids and the offers? Like, how did that go?
Right. So we did not have a model. Like, it was not automated. So we were the model. It was up to us to manage the book and manage the P&L in a day. And usually when people used to trade in pits, if you go back and a generation behind us, like last week, I was part of this game here called Stock Slam. If you guys know, Chris and Tina organized this program, how the trading pit takes place, right? They don't really have a model except a mental model. So I'll tell you a few examples without leaking out. There's something that I, in a public forum. So when we were when we were in the markets, right? There's a certain behavior of a given bank that you can detect that, okay, they are doing something. Like, for example, there's a small bank on a typical daily basis, they will trade, let's say, a quarter mil ticket with us, on the whole day, $250,000 in the whole day, right? And then suddenly one day they are asking for 5 million quotes, or they are asking where's the market for 5 million, right? And of course they are not that stupid, they will not come at 5 million, they will come at 500,000. But let's say they come at 500,000, you give them a two-way price, you show them a two-way price, they hit you on once, and then you say, okay, where is my book? So I will show them a price based on what the last traded price was on the market, what kind of inventory we are holding up. And I will either try to skew. So anything, Raghav, that we eventually when I came to US in New York, all of this was built in models, the quant models, that we started working on, because that's what I got trained for. But in the absence of that, that's the feel of the market that we used to get. And we would quote our price, skew our prices, skew our spreads. And what will often happen is, well, let's say we quote a price which is 1 paisa wide, and then they will say, "Nahi, give us something narrow," because they want a better price. Whatever price they want to buy or sell for is not there, so they can negotiate. And that's what happens with an OTC market. So let's say I showed somebody a price and they hit me on one side. So they, let's say, lift my offer, right? So I technically sold to them and they bought from me. So I'm now short in the market, but that's okay. I'm running an inventory. I'm running a book which goes long and short, right? Net or none basis. So the expectation is over the whole day, if I'm constantly buying and selling with different counterparties, I'm eating the spread. That's my expected P&L for the day if I'm able to manage the risk of any large move. But let's say this bank that in my example, they came in, they traded with me 500,000 today. They usually don't trade that much, but let's say in 10 minutes they will come and let's say they are asking again. And now there are few things to consider here. Now I'm trying to detect what are they trying to do. My first instinct is to pick up what they are trying to do. Why are they coming and asking me a code? There is no way they are trading without any reason. They are not like कि board बैठे हैं चलो अभी आधा मिलियन खरीद लिया आधा मिलियन बेच दिया. No, that's not why banks trade, right? So there are two things I will observe. Let's say when somebody comes in and asks me for another quote, A, where the market is. If has market significantly moved? So for example, when they lifted my offer, I went short, they went long, and let's say market moved up, so they are in the money. So they might want to sell back to me. But then that's also, you also know who are the people who are the banks who do this actively vis-a-vis the banks who are not. So, but let's say this is the bank who doesn't trade often. I know they are not trying to sell back to me. I know that in a probabilistic manner, not in a deterministic or a 100% sure manner, but in a very probabilistic manner, I know they are likely to buy again from me. So what I'm going to do, I'm already short. I don't want them to sell. I don't want them to buy from me in an adversarial way for me. So I would skew my price. So if the market is quoting 70, what's the rupee right now, 81 something, I will quote them a price so that they can buy it from me at 82, so that I can quickly turn around, hedge my risk out at 81 and eat the spread. I don't want to hold that risk because I am in a way are able to pick up their footprints, right? I'm able to detect that they are trying to buy it for a reason. And that's why the negotiation, it used to be so interesting, because you'll show them a price, either they will pass or they will hit you. So if they hit me again, so I know that the market has 81, but I gave him an 82 and he still hit me. That means he's an aggressive buyer. Now if he comes again at me, I know I'm not going to quote them on one side, or I'm going to skew it really, really high. And so that's where all the game theory comes into play, because they might not only be hitting me, they might be hitting 5 other banks. So what if RBI is behind this bank and they're trying to intervene in the market through these banks? So suddenly everybody, all the other banks are short in the market, and there's shortage of the market in dollars. Everybody's scrambling to buy their rates. So this is what happens on a day-to-day basis in an entire market in every instrument. Luckily, in that spot when I was able to see it firsthand materializing into one trade going from one side to another. And then as you move on, you try and quantify these behavior where as much as you can. But then as a retail trader, as somebody who's outside an institution, things are very, very different. You don't have the same kind of edges of information, of speed, of quant power behind you. So you kind of have to uh, adapt to it, right? So again, a long answer. I'm not sure if that's been useful, but yeah, that's what it used to be.
Oh boy, that was that was super detailed, man. And I think um, the inventory management sort of carries on. It doesn't matter what instrument you're making markets in. The interesting thing here is the knowledge of your counterparty sort of directing your trading behavior, and it's almost like poker slash market making slash ये क्यों इतना bet कर रहा है आज
Yeah,
बहुत tight खेलता है this he's a tight and aggressive
right.
guy, why is he betting so much today? So super interesting, man. So I think we'd be remiss if we actually don't talk about our topic, and like from a market maker to a market maker, let's make a slight pivot towards um, the emphasis on the spaces is about using a form of Monte Carlo analysis. And I know you've done a spaces on this before. I was a big fan of that particular spaces on Monte Carlo right after you released that article. And I'm hoping a lot of people have read that article. If they haven't, the link is in the tweet where we were promoting this particular spaces. So you should definitely check that out. But before we jump into Monte Carlo, let's build the basics out a little bit. We'll start with understanding what backtesting is and how do we actually get to that Monte Carlo. To get to that Monte Carlo, we should probably first talk about your methodology in coming up with a trading strategy So the cadence of this conversation, I think, like the way I'm thinking is, and let me know if this is good or if you have some alternate suggestions. But the thought here is, we'll start talking about research, backtesting, and then within the scope of backtesting, let's dive into Monte Carlo. Okay?
Yeah, no, that works perfectly.
Awesome, awesome. So yeah, let's start with sort of research, right? The first step towards backtesting, or the first step towards building out a successful trading model, successful trading strategy, and running it is, how do we go about forming a hypothesis about the market? Okay, what do I actually want to test? So what do you like? What role would something like charts have to play here? You've been a charts guy, so maybe start from there, and then like, how do we go about building intuition about the market so that we can actually come up with you know good testable hypotheses to actually test with data?
Right. So, there are, in systematic trading, there are broadly two ways to do that. One is an ideas first approach, and the other is a data first approach, right? So ideas first approach is where, how I grew up, at least, by anybody who's watched charts or who has watched the market. And there are a lot of traders in today's market as well who don't even do charts, right? They will, let's say, look at the quotes and tape and whatever. There are hundreds and thousands of techniques to get a feel of the market. And even in today's market, in our Indian market, you will see someday some straddle is at this price and people will say, oh, this is underpriced, this is overpriced. Well, whatever the mechanism they have to get a feel of the market. And then everybody starts forming these hypotheses, or that if this happens, then that happens. For example, if on a Wednesday, Bank Nifty straddle is under 300 rupees, then, there's not so much decay left. And now this could be, you and I and anybody else can argue whether this hypothesis itself makes sense or not, but this is a valid hypothesis to try and test out. In my earlier example of FX, the hypothesis was this XYZ bank is a small bank and they do not have that large of a book to trade that size, and they're just coming back again. So there's something behind it. Like, it's not as much testable. It's more based on the gut feeling, but then, it's again an hypothesis. In a chart world, if some of you might have noted, since last few weeks, I've been talking about gap trading in the morning hours, right? So there are, so the hypothesis is, let's say, for example, if after 5 days of trend, the market gaps up by XYZ%, then it's going to retrace, right? That's another hypothesis, and so on and so forth. You can form hypotheses from market observations, from looking at charts, from reading other people's posts, blogs, videos, be it, the world is your oyster, really, to form trade first or intuition first hypotheses. So that's how, so let's take a simple example. Let's say if 2-day high is broken, then market is going to run 0.5%. And this is just a testable hypothesis. So you'll create that one. These are intuition first or idea first, depending on whatever your idea or reading of the market might be. And then the second source is the data first approach, wherein you are not, of course, you still know what the markets you are trading, but then instead of prescribing what the markets are going to do, you start digging deeper into data and getting your hands dirty. So you kind of try to at least go with no biases. You try and go with no null hypotheses, so to say, saying that I don't know anything about the data except for the fact it's a time series data of, let's say, Nifty index, and I'm going to do all sorts of analysis. Some people may call it data mining. It has its own challenges, but I find it to be a very legitimate way of finding patterns, which can be repeated and can be quantified. So once you start doing this analysis or explore the data, you may come up with your own hypothesis. For example, I'm just putting out numbers that you see, okay, every Wednesday is a 2% move, and then a following Thursday is a 0.5% move. Just random numbers, I'm putting it out there. So these are kind of the two sources from which you can form an hypothesis, and then you can set to test them out, right? So the testing could be research and backtesting. It could be only backtesting. So research and backtesting kind of fuse together in a way. No matter how well you try and segregate them, there's bit of overlap for sure. But then essentially you take such ideas and then you put them to research, you try to see where it breaks, you try to form a system and backtest it. Uh, so yeah, that's kind of a background on that.
Yeah, that's really interesting. Going from A to B or going from B to A. In your experience, both these approaches have led to um, profitable trading strategies for you.
Oh yes, yes, definitely.
Awesome, awesome. Yeah, so our platform actually, um, there's really not much of a research step in our platform, right? So usually people start with the back test and sort of play around with it and come up with frameworks that have made money, strategies in general that have made money, and a lot of people have traded those and made money. But there's also pitfalls that we've actually done conversations on before, things like curve fitting, and I guess people can find the previous spaces, uh, the
Yeah,
previous spaces that we did. Yeah, go ahead.
sorry, the only thing I would like to point here is it's usually, data mining is usually frowned upon. A lot of people say, hey, you're trading these straddles and strangles, the stop loss. That's not how options work. But then on the counterpart, there are enough people who say you strip off all the labels about a strategy, all the labels about a P&L generation process, and I'm going to see if there's a statistical process behind it. And the biggest proponent of that approach has been Jim Simons, who actually in his book writes, I don't know if this happens, why sun goes around the moon or whatever, just random example. But hell, if it happens, I can statistically prove that it repeats, I can make money off it. So, I'm trying to, at the risk, at the risk of saying, I'm simplifying things too much, but uh, but yeah, there's the data first approach is a valid approach. It's just that the way I work is and it's harder for you to completely do a data driven approach. So for me personally, whenever I've found database patterns, I've tried to think about why would it exist, what kind of biases the market carries, or what kind of behaviors or risk factors to market carries that it will give me this output. And that at least lets me sleep at night without being while trading a black box, with my money on the black box. So it's hard, but then it's definitely possible.
Well, that's again another interesting observation that if you do take the data mining approach, the data first approach, and try to find repeatable patterns and sort of see if they can be converted into profitable trading strategies, there always has to be sort of like a backtracking of trying to sort of paint the picture in a complete manner to try and figure out why this is happening. It is happening.
Yeah,
It's leading to action. It's leading to profits. But why is it happening? That's an
right.
interesting mental
Yeah,
exercise,
because
and that, yeah, go ahead.
on a data mining exercise, you can very well fit to the noise, right? If your look back period is last 2 4 years, or let's say in Indian market context, the weekly options, you can very well fit to something which is noise, and unless you run some tests on those distribution of returns. So there's, it's just a start. I would say, Raghav, like using a platform like AlgoTest and bringing out, let's say, XYZ systems out of it is just the start of the research process. You have to really, वो कहते हैं ना ठोक बजा के उसको देखना पड़ता है कि it's not breaking, where is it breaking, where does it leak, right? To really be comfortable on putting money behind it.
Yeah, awesome, man. I think this relates well with the one tweet that you had around a 920 straddle and how fitting a 920 straddle strategy in the framework of just being a regular option like a delta neutral vol trader. The like fitting the 920 straddle in that framework just sort of leads to the conclusion that you're essentially just like your stop losses essentially just become delta hedges with
Yeah.
opinions. And this is also something that you picked up on, and that was when I was like, okay, man, I got to talk to this guy.
That's when we
Um,
spoke. Yeah, yeah.
that's exactly right. So yeah, man,
Yeah.
that's that, and I think that was really cool because I actually had to go through that sort of head scratcher of sorts. When I saw people making money in running variations of 920 straddle, it was very difficult for me. Like I'm essentially building. I've built a platform now that lives and dies by by the 920 straddle at the moment. But it's something that certainly was a head scratcher for me the first time around. That why and how could this happen. And I arrived at the same conclusion as you, but I had like conversations with people much smarter than me to try and figure out, okay, like help me sort of get to that stage. Okay, what the hell is actually happening? So that was really cool to see, somebody actually pointed out. And I did hear from people that, as part of that tweet thread that you had, that people in the industry were also sort of doubting that, but I would actually agree with that hypothesis 100%. So awesome, dude, awesome. So now the next sort of thing is, uh, we have a let's say you went through your research phase, you came up with one way or the other, either observing something in the market, and testing something out of it, or the other way where you talked about data mining. Now you have a trading strategy. What are the most, or like you have a back tested traded strategy, you have the historical results in front of you, you have the statistics in front of you. What are the most important stats that you look at?
So I would like to look at any back test. Of course, the returns have to be meaningful, but it's from a risk perspective is what I would like to look at it first. For me, the absolute metrics like win ratios or sharp ratios. I mean, of course, these are all looked at. But when I'm back testing a strategy, I'm trying to see, uh, is there a version? So why am I doing this? Am I trying to diversify what I'm already trading? Am I trying to research a new effect that I'm probably not trading? Uh, or is it like, some random idea I'm just trying to see if it sticks, right? So there are quite a few ways of motivations to read up, or build up or backtest a strategy. Now, once those strategies are created, it has to be, everybody has to be mindful of the fact that you backtest the same set of rules over different windows of data. Different windows and different sizes of data will produce very different metrics. So in a way, this sharp ratio or win ratio or average win or whatever metric you are creating is itself is stochastic, or in simpler words, it's itself is a moving number. So you run the same rules for 2017 to 2019, your metrics will be very different. 2019 to 20, very different, so on and so forth. And it's constantly, it's not like a static number. So you can't be like, okay, this in the back test the sharp was 1.0 or 2.0, whatever it kills, I'm gonna take it. Yes, it helps you understand uh, what it's doing overall, but essentially, these metrics are just a snapshot of the current data that you've put into your backtester, so called, and come out with the metrics, right? What's also important to look at is, I always do that, is the equity curve. How would it have behaved? It may happen that, do you have outliers? Is it possible that your 80% of the profits are being made on only 5% of the trades, which might have been lucky streaks? You just happen to be on the right side, and 95% of the time you've lost money. So you want to see an equity curve. Now, a lot of people say that they want a smooth uptrending equity curve. Yeah, I mean, I can fit to data, but I don't care. All I care about is it behaving as I would have expected it to behave based on an intuition first approach. So let's say if it's a short vol trade 2020 in the March, did it went burst? Did it burn out, or did it make money after the cool off? Right. So in different pockets of the stress in the environment, how did that strategy behave? And of course, it has to, all of this has to followed by if the strategy itself made money. Otherwise, if you backtest first and something is completely going down south, you probably, as a human, would discard it. It's very hard to stick to more research on the something which right off the bat shows a negative expectancy, right? So you need to have something which is positive, and then you try to start breaking it apart, and you start looking at those paths. So those paths, and this will actually lead us to our Monte Carlo discussion. These paths are, so you have 100 trades in your back test. Now, what is the guarantee that they would have occurred in the same order, right? Like you have 10 wins and 10 and then 3 losses. It could have been in these 13 trades, could have taken place in any order whatsoever. Yes, you can look into more detailed, you can look into more detailed logs behind those trades. For example, people say on expiries, it's easier to eat theta, whatever. But we have seen in last 2 months people are getting killed on expiry. So that whole hypothesis that the expiry trades are different than Wednesday trades may not be true. I'm not saying it is or it is not, but it may not be true. So for me, the long story is there's no fixed. I get this question in DMs a lot. People will share the statistics of their strategy and ask me, "Is this a good strategy?" And I tell them, I don't know. I have to really know what you're trying to trade, how you're trying to trade. Is this, I can make a like to like comparison. If you come and say my momentum strategy has a 50% win rate, then I'm going to say, okay, now that's interesting, because typically momentum will have 35 to 45, maybe 50, 55 at the max. But if your strategy has 60, 65% win rate, then I'm interested in understanding how you're doing what you're doing. Whereas somebody brings in short Vega or the short Gamma kind of a strategy and says, "Oh, I have 40% win rate," then I can tell them that, look, guys, there are other people who are getting 60, 70% win rates. Think about why you are so on the other end. But that's only from a like to like comparison. But if somebody strips out all the information, just gives me the statistics, I can't say whether it's good, bad, useful, not useful, nothing. It's just you have to dig deeper, and that's what I try to do. Try to understand what's going on behind that equity curve, behind the trades. After a backtest.
Super interesting, man. Very, very detailed, and I think there's a lot of really interesting nuggets here. Specifically, the idea of understanding the property of the system that you've just created, and using that intuition that we talked about earlier to sort of guide and understand, or at least like form a hypothesis around, hey, if it's a short ball strategy, how did it do during the COVID crash, and did it lead to like if it's a short ball strategy that's not intraday, so you're actually playing the game. If you figured out a way to not blow out during that time in a short ball strategy, when vol came in, did you actually make money? Like that resonates with me quite a bit, and it's really I think that's sort of an interesting sort of higher level analysis of a trading strategy, looking at it qualitatively post a back test to make sure that your story is complete, that there aren't any holes in your story, and that's something that um, I think that's quite valuable. That's really
Yeah,
quite valuable.
and the tough part is that story will change in 3 months. That's why trading is hard, because it's not that whatever story you tell yourself after the backtest is gonna stick around. The markets itself are evolving. Everything that you're trading is constantly in motion, so to say, right? So, this is not like a one-time exercise. I try to tell a lot of people that when you're trading, you have to, as much focus you have on testing out new ideas, you still have to have focus on what the output of your current systems are, because that also tells you the changing market dynamics, or there's so many things you can decipher from this, uh, the footprint that your own trading leaves, not in the market, but at least on your portfolio.
Yeah, so this actually segues into drawdowns, right? So drawdowns is one of the more popular risk measures, popularized uh, by, like, we're guilty of popularizing these over others as well. But so yeah, let's start with drawdowns, and then maybe we can like bring it into the Monte Carlo framework. So what's you talked about? You don't look at statistics. You don't look at any particular statistics on their own. There is a story that you look at. But how important are drawdowns in that story?
Right. So probably I didn't convey myself correctly. It's not that I don't look at them. I'm just saying, for me, not only one item is not supersedes the other one. It's just that
Right.
if it shows a negative or lower number on one of the metric, that does not necessarily mean I will go ahead and trash it. Right. So
Mm-hmm.
it's just a start for me. So drawdowns are fairly important, right? And one thing that I'd like to say here is, um, you give me a number on a percentage drawdown on anything, and that can be modified into another percentage just by changing the capital that you allocate to it, right? So you tested a strategy and you had X percent of drawdown. I always look at percentages. from a capital perspective, I'm not looking at points or whatever, because, for example, 10 years ago, 5 years ago, Nifty was at a certain another level. So 10-point move on Nifty back then is not the same as 10-point move today. And it will not be the same 10-point move 10 years or 5 years down the line. So it's not the right way of looking at, you're not really making a like-to-like comparison unless you kind of normalize the whatever numerator or whatever you want to call it. You bring it to a percentages domain, then you are sure that you're looking at a relative comparison throughout your period. So I always look at percentages first of all. But now let's say you bring a strategy and you say, Ankit, this has 40% drawdown, I don't like it. But you can very well morph it into a 20% drawdown by allocating more capital to it. So your return expectations will also go down, but so will your drawdown be. Now, then the question is it good enough? Do you want to, that brings me us to the earlier point I was trying to make, that the focus is on the risk. So risk is not only drawdown, but also the variance. But since we are talking about drawdowns, if I am enduring a drawdown of 20%, but I'm making 100% on that, do I want to take that, or do I want to really go to a 10% drawdown? And if I'm fine with 20 to 100 ratio, then, but my strategy is giving me 40 to 200 ratio, then I can just, pull the lever down. I can deploy more capital on the same strategy and still sleep peacefully. So, that's how the drawdown numbers are themselves are really dependent on, the capital that you're really deploying on it. And you can bring a painful system into a comfortable system by using more capital. Whether that meets your return goals or not is another criteria, another question, but then at least from a risk perspective. So drawdown is definitely something that you look at, and it's an important metric. It's really your pain threshold. On a standalone strategy, I might be willing to take more drawdown if it provides me some diversification. So, some time back, there was a very interesting thread on Twitter on negative expectancy strategies being run, and should you run them if they improve your Sharpe. So technically what they mean is that you run a strategy which otherwise breaks even or makes small losses, but then when you include it in your portfolio strategies, it includes, it kind of hedges out your variance, or reduce the variance of your portfolio, improves your Sharpe. So you're not making money out of it, but you're reducing your portfolio variance. Is it something that is, what's the maths behind it? So these are the kind of questions you like try to answer, but drawdown, is an integral part of that analysis.
Awesome, man. Awesome. Like it's amazing that I was talking about drawdown, and sort of like a more holistic way of looking at drawdown is, again, there's no right or wrong answer here. There's no percentage threshold that Ankit looks at. It's more just a function of, in the context of the strategy, in the context of, and that's exactly right. It's the maximum pain threshold that you have, and you can actually decide whether that how painful that pain threshold is going to be by just tweaking the capital that you're going to deploy, or the proportion of capital that you're going to deploy. Just tweaking that lever high or low, you can sort of decide whether you want to take more pain or not. Sort of a masochistic way of looking at it, I guess. But anyway, so now that we've talked about drawdown, that's where the question comes: okay, when should you stop trading a particular trading strategy? One measure of that is, again, your drawdown, which says that, hey, historically, if my strategy has achieved this much of a drawdown, and so that sort of mentally prepares me for the future. That says that if my strategy, if my backtest has shown me this much of a drawdown in this particular strategy in the past, how can I guide that? How can I guide that to make better decisions in the future with respect to the same strategy? And whether that single point estimate of a drawdown, how much value does that have, and how much should we use that as opposed to the Monte Carlo approach that you mentioned? So maybe you can start with that initial question and then segue into your framework for Monte Carlo.
Right. So I think it will touch upon quite a few things that we have discussed so far. So let's say you've done all the analysis. Now you have a strategy, you have the percentage number, be it whatever you want to be, but that's your base case. That's your backtest. How you consume that backtest in the portfolio is another question, but that's really your base case. Now, you start live trading it, and the assumption is there is some sort of edge, there's some sort of market behavior that will allow you to trade that strategy so that it's going to make money, right? uh, and then like I said, the first point to note is you back tested your data on a certain look back window, as in 4 years, 3 years, 5 years, whatever might the data be. And that itself might also be the size of the data, so it might be from 2017 to 2019 is also a 2 year period. 2018 to 2020 is a 2 year period, and so on and so forth. So it's the length of the window and where it's placed in the historical data, which will really give you a drawdown number. Now, in when I started systematically trading, like when was making all this transition. So, by the way, I went from discretionary to being a pure quant, like pure math basis, and then I moved into this retail systematic way. So, there was a lot of learning for me to do as well on how things work in a non-institutional environment. And one of the very common method is to say, hey, if my backtest said X% drawdown, and if my live trading hits 2x drawdown, then my strategy has lost its edge. And whatever it is, I need to trash my strategy. And when you're starting out, that's a decent metric. At least one thing you got right by doing it is you're trying to cap your risks. You're trying to say, I'm not going to be blindly following the strategy till eternity, till it blows the fuck out of my account. I'm just going to stop and cut my loss at some time. So having that sort of SL or risk metric, whatever you want to call it, is definitely a good start. But then what the article I wrote about kind of challenges this notion, because for a couple of reasons, right? So first of all, the backtest that you ran, like you said, is a point estimate. So what do you mean by point estimate? It's just one output, right? You ran that on specific set of data, on specific period of data, which gave you this, let's say, 20% drawdown, right? So it's a point estimate. It might, if you would have run it, let's say 1 month lesser of data, your drawdown might have been different if if the drawdown occurrence was most recent, or if you just ran this back test starting after the worst drawdown period, your drawdown might be 2%, right? So it's just an estimate based on what the data input it had. So that has to be kept in mind. And then the other challenge is that why 2x? Why not 3x? Why not 1.5x? What kind of statistical analysis can you do on this time series that you generated as a backtest to get some comfort around distribution, or when I say distribution, it's the possible values that a drawdown number can take in real life, right? And that's where the Monte Carlo kind of helps it. Now, I just want to draw out a disclaimer and a warning before we go into it, is that it's just one tool, right? It's not holy grail of drawdown analysis. It's just one way of looking at what you tested out and seeing how would some of these things will behave. So like I said, the one metric is 2x or 3x or 1.5x of the historical drawdown. You cut it out at a bare minimum. That's if it's not your stopping point, it could be a point wherein you pause the strategy, go back to the drawing board, see what has changed, or why did it face that drawdown in backtest versus live. Is this change permanent? Like, for example, margin changed, and things which were like, now the OTM options are slightly more bid, the walls are more bid because there's more demand to it. So, there's a structural change. Or is it something, which is just noise, which is the market is going through its own gyrations, and, it's just going its natural course. So at least you can take that pause and try to analyze this. So that's on a very simplistic manner. And then we can talk about Monte Carlo. I'm not sure if you have any thought on question on that.
No, I think it's.
But we.
No, I think I like the rigor, man. Like any sort of general statement is made super precise by your filling in the gaps. And what I said about the point estimate, you filled out the gap really well. Like there's questions, there are very specific questions that people start with, but what they don't do is sort of in a meta analysis of the question ask, why am I asking this question, or why have I decided this number? So why the 2x, right? People understand what the drawdown is. They know that the drawdown is something that measures the risk. It can be painful, but then why the 2x? Why this particular threshold? And whether whether is 2x the right number to actually stop, when, like you very, very articulately mentioned, that the market could just be going through its motions, that your strategy could still very much have edge, and you could still very well be within your risk limits. Even of a 2x drawdown, you could still very well be in those risk limits, even though this particular realization of the market, this particular gyration of the market is bringing your drawdown to a 2x. So with that, and the added caveat that the Monte Carlo approach is, which you have actually popularized. Maybe we should, in the Indian context, we should call it the Ankit quant approach to.
नहीं नहीं,
glad I made you.
let it be MC.
Glad I made you laugh a little. Okay, so the next step would be, let's actually talk about this Monte Carlo approach with all the caveats that go with it.
Yeah.
That how do you go
Yeah.
about it, and over to you, man.
Right. So by the way, I laugh a lot. Like, it's only when I'm talking seriously, I'm like, this serious. But anybody who speaks to me will know I joke around. I'm fooling around a lot. So, not that I'm, such a such a
Yeah,
serious
I
guy.
didn't imply that. I was just like, in a serious,
Yeah,
in a
no,
very
no.
serious topic, there's a bit of levity. Chalo, carry on.
Yeah, sure. So let's kind of try to introduce what Monte Carlo is trying to do, without going into technicalities, on a fundamental basis, what you're trying to do, right? So everybody understands a backtest. Everybody understands a backtest is a sequence of trades. Let's say, for sake of simplicity, you have 200 trades. They all went through a P&L, and a realized P&L, as in at the end of the day, you took this trade, it was either a profit or a loss or a break even. Even though in break even never happens, you rarely ever will have an exactly zero P&L trade. It will either be slightly positive, slightly negative. So technically, I would say it's only two categories. But let's say, for sake of covering every corner case, there are three categories. It will be winner, loser, or let's say flat, right? Now you have these 200 trades, and now when you try, let's say you try to visualize it in an Excel sheet, you number them 1 to 200 in rows. So one, uske niche, followed by 2, then 3, and so on. And then another column, you put your P&L into it. It might be 0.5%, 1%, 2%, whatever might be, 100 rupees, 1,000 rupees, whatever way you want to do it, right? So and then you draw an equity curve, which is sequentially saying first trade win 100 rupees, second trade win 1,000 rupees. So after two trades, my equity curve is at 1,100 rupees. And then you keep on adding the next trade P&L to the equity curve, and it will draw this whole chart for you, which is the usually what you want, the sloping curve. So essentially, if you think about it, this equity curve is these 200 trades from in a column going from top to bottom, and you are adding them one at a time, one after another. So you're adding trade number 2 to trade 1, 3 to the sum of 2 and 1, 4 to the sum of 3, 2 and 1, so on and so forth, right? So your output is heavily dependent on the sequence, right? On the trade sequence. And if anybody wants to try out, if you can try it out as an exercise with 10, 15 trades. You put a 10, 15 trade in an Excel sheet, draw an equity curve, and then you shuffle them around, right? So you essentially say, what if the 13th trade, which made me 5,000 rupees, happened at the first instance? Or if the 12th trade that lost me 7,000 happened at the last one, right? So you try to change these numbers around. So you just, shuffle them like a pack of cards, and that will give you another equity curve. So you have your backtest curve based on your rules. But then now you're saying, hey, I don't know, because the markets are noisy, they are sort of stochastic, they're moving around. It's fairly possible that even the same set of outputs of 200 trades might come in a very different order. The backtest that I ran was just one particular order that my backtest ran. So from a statistics standpoint of view, I'm trying to create, for a lack of better word, alternate worlds, right? On Star Wars world, you have different universes. So you're trying to create alternate paths such that your starting point in all of them is still zero, because it's the same set of trades, and the end point will also be the same, because if you do a simple math, if you add up all of the P&L, it will come up to the same number. Let's say that number is 2 lakh rupees. So no matter in what sequence the trades will happen, your total P&L and your starting P&L, which is zero, will always be the same. The only thing that will change is the shape of your equity curve. And actually, in my article, I showed an example of that with 5 5 examples. And what we call this, technical word, it's called a simulation. So you're simulating that what would have happened had these trades occurred in any other order. So you do it once, you do it twice, you do it thrice. You can do it as many times as you want, and with code and computation power, you can run it 1,000, 10,000 times, as many times as you want. Now, the thing to note is, let's say once you did it for the first time, you went from the base the base backtest, to the first time shuffling the PNL or shuffling the trades around to create another equity curve. Now, this new equity curve, or the equity curve 2, will have its own drawdown. And you can try, everybody who doesn't understand it should try doing it in the first principles. You take 10 trades, you put random PNL on it, you sum it up, and then you change the PNL. You just don't change the magnitude or the side of the PNL. Basically keep the positive trades as positive and whatever the number might be, but just straight change the occurrence of that trade, and you will see that second example or second simulation will give you another drawdown. So now suddenly, for the same strategy or the same set of PNL outputs, you have 2 drawdowns, right? Now you can do this 1,000 times and you will get 1,000 drawdown numbers. So now you are moving from a deterministic or a point value estimate drawdown number to a distribution of potential drawdowns. These are some keywords I'm trying to sidestep so that, it doesn't imply something which doesn't mean. I'm not saying that the same strategy would have generated this, but I'm just saying we don't know. The markets are not likely to repeat exactly the same sequence of trades in future. So we are looking in a probabilistic manner, what are the alternate possibilities, assuming these are the only trades that could have happened, right? So now you do it 1,000 times, you have 1,000 drawdowns, and you draw a distribution of those, which is if people are familiar with this bell curve or the histogram, right? And that's again on my website, on this article, you can see it's, visually. So histogram is saying, okay, now I have these 1,000 drawdowns. How many of them are above 40%? You can very well count them as, let's say 2 of them are above 40%. So, I did it 1,000 times. Only 2% of the time it was above 40%. So, you can say it's very less likely to have occurred again. And you can do this exercise again and again. So 40% is, let's say, your top bucket or whatever the number might be. Then you do, okay, how many times it was above 39% but less than 40%? And so on and so forth. You can create these buckets and see, out of those 1,000 drawdowns, how many were in that bucket, right? That's called drawing that distribution, looking at that histogram, and trying to see where are the outliers, right? So where am I expected to see my drawdown in forward trading? Is this middle of the curve, or once they call it 1 or 2 standard deviations, depending on how sure you want to be. I don't want to go into statistical details on that, but this exercise of changing your 1 drawdown to 1,000 drawdowns, keeping in mind your starting point is 0 in all of them, and your final PNL is still the same. You will still make the same amount of money, but you will just come from a different path, right? You will, for an example, if you're flying from India to New York, I can fly directly over the Atlantic, or I can fly on the Pacific side. So basically, I can fly west of India to Europe to US, or I can go from India east, so over Japan and then San Francisco to New York. So it's the same destination, it's the same source, but the path is different. And that's what this Monte Carlo is trying to do for you. This approach, which is very frequently used in a lot of simulations in financial markets, wherein you can't model the behavior. You try and see, okay, you have some assumptions and you run 1,000 times the same output or same process and see what are the outputs. So I'm going to take a pause because it might be a lot for people to digest. It might help for people to read the article, but that's what it essentially does.
Yeah, I think that's very beautifully summarized the article, and I think the explanations here in the explanations in sort of more common parlance are super helpful as well. So now the next question around this is, when Ankit, when he starts building out a trading strategy, you have a hypothesis, you build a testable hypothesis, you test it, you you by test I mean you backtest it. Then the next step to that is you perform this particular analysis of Monte Carlo. Like the two questions I have is what like what is a stable distribution in a Monte Carlo, where you look at it, you perform the Monte Carlo analysis, and then you're like, okay, this looks good. I understand the drawdown distribution that allows me to trade this particular system or move this particular strategy into the next step in my pipeline around whether I should like it's past this Monte Carlo filter. Like what would be the criteria for you to decide that a particular strategy passes or fails this Monte Carlo filter?
Right. So in my pipeline, Monte Carlo is not a filter. It's just about painting more color, or just like think of it as another metric that your backtest is creating. Like I said earlier, there is no one way of looking. This it's not like only Sharp or Kalmar or whatever might be. So for me, this Monte Carlo is just a simulation to see, uh, what is realistically expected. Like so, suddenly I moved from a 2x of drawdown. So earlier, if you were using a 2x metric and saying, oh, I need my backtest drawdown to be less than 15% because in live I will expect 2x of it or 30%. So I need it to be under 30% in live so that I can make money and I can sleep at peace. And that's why I need the backtest to be 15%. So you're kind of forcing yourself onto what the market is trying to do. And that's not how it works. I would rather take a step back and say, okay, this is what I tested out. This is what the Monte Carlo is showing me. I mean, we have to take it with a pinch of salt. It's just one time of simulation. I run the simulation 6 months down the line. The results will definitely be, most likely, be very different, right? So it's just telling me, okay, in the basis of this Monte Carlo, which is, what I'm going to look at is the middle part of the curve, or maybe 95% confidence interval. I'm going to say, I need not worry about 2x drawdown because it's fairly possible that in the back test, this backtest could have taken another path and my drawdown could have been 3x. So, within the same set of outputs, I can still make money even if the drawdown is 3x. Or in the other side, it may say, hey, out of the 1,000 simulations, only 0.5% of the time was drawdown more than 1.5x. So that will tell me, if this strategy starts breaking, then, at 1.5x itself, I have to start looking into it. And there's another caveat here is the number of trades. If you have 50 trades in it, whatever you're trying to do is not that meaningful unless you put some more statistical tests on it, because you just don't have enough data to support your analysis. So let's say, but if I have 500 trades, and then on the basis of that I'm saying, oh, my Monte Carlo drawdown is never above 1.5x, then I know in live trading, if it's 1.5x right away, I will at least pause. So it's not really a filter. It's just putting another metric which will then go into another pipeline. Uh, does
Yeah,
that answer?
awesome. Yeah, absolutely, man. Absolutely. Um, yeah, thanks for that. The next follow up to that would be, what other criteria do you have besides the Monte Carlo? Assuming that you have a backtest report, you have all the statistics in front of you, you've played the Monte Carlo game with the drawdown. What else? And this is something that you've popularized, the Monte Carlo approach to figuring out a distribution of drawdowns. What else? What else that would you do that is not, that's not part of the Indian FinVit and Volvit right now, that would, without it being some kind of an alpha leak, I'd like to understand, more like a process leak. Okay, what else do you have in your process that uh, that you can reveal and talk about with users besides this Monte Carlo?
Yeah. So I think there are a lot of people in Indian FinTwit as well who are doing some fantastic stuff. They just don't talk about it.
Mm-hmm.
So, I think whatever I've spoken so far would be known by a lot of people in some form or fashion who might have listened to you so far, right? So I don't think any of this, what I'm saying is novel or, something path breaking. I just want to draw that caveat out, right? Now, in terms of the process, for me, it's never about a single strategy. It's always about how does it fit into my existing trading? Like we are all trading already. Uh, if I'm backtesting a new strategy, it either has to come from the fact that I'm trying to harness a new way of making money. So either let's say completely different kind of method. So right now, let's say it's index trend following primarily my goal, but I want to trade stocks trend following. So that's another, that is where my research will start. And then let's say the research ends and I have a back test and I have an output. Then I will say, okay, now I have the same pie to distribute. I have the same amount of capital, or or even whatever the amount might be. I'm already trading the existing portfolio. How do I blend this in? So that's where a lot of my work and my thought process goes in. How do you weigh them? How do you kind of weigh different alphas, for a lack of a better word? And these alphas could be different strategies themselves, or these could be different versions of the same strategy. So a few days ago, Prathamesh did this podcast with Arjun, in which he talked about how you can change the parameters of a strategy, and then that itself counts as a diversification. Now, I just want to draw a disclaimer here. I'm not trying to say that you run one 925 straddle, one 930 straddle, and 945 straddle. That's not really diversification. I mean, it is to an extent, but not what you would want to do all the time. There's another layer on top of it wherein you say, okay, this is, let's say I have 5 versions of 920 strategy. Okay, I will bucket all of them in one bucket, right? That's my, let's say, short wall / short gamma book or bucket. And then I will say, okay, now I have another trend following bucket, which again may have 1 or 5 or 10 or whatever alphas or strategies giving one output. And now I want to put all of them in a single portfolio. So that's where the research comes in. I think, my current focus is on how do I bring in these different strategies in a capital efficient way on the account that can help me, diversify my risk and generate the returns, right? So one strategy is just such a tiny part of the entire framework that, as I think in Twitter I've said it all the time, backtesting is just the start of my analysis or trading deployments, right? It's just the start. It's not the end. It's the start of my research. It starts there, and then uh, there's a bunch of other things that needs to be done before. And even if I'm, let's say, so I actually made a modification a few weeks ago, and one of the modifications I made was I changed some of the parameters based on my observance of how the market has been behaving in a particular fashion. So I was seeing some risk in a given manner. I just don't want to delve deeper into it, but I was seeing the risk in a certain manner, and I did a little bit of analysis and said, hey, this parameter needs to be changed. It may be curve fitting, but it was thought of, it was driven by, okay, there's a sound logical reason behind it, and I'm ready to give up probably the potential returns that I was expecting to get out of it, but I'm trying to reduce the risk that this thing is taking. So that goes back to the point that you trade, you see the output, and you go back to your drawing board. So that's the kind of process I try to follow.
Got it. So more process oriented. You mentioned a book earlier. I made a few notes while you were talking. You mentioned a book earlier. You talked about James Simmons' key book. Do you have any other books that you could recommend to people interested
Oh
in
yeah,
this?
I have a thread on quite a few books. I have actually 2 threads. One is on the options trading books, and one is on just systematic trading books. Uh, so it depends. Again, with the book you can learn so much. Depends what you want to learn, right?
Hmm.
So if people are trying to learn how generally markets behave or how people trade, there are books like, if you want to. So I'll try and categorize quickly. So if you want to look at how frequency markets trade and what makes those things take, there's a book called Flash
Hmm.
Boys, Flash Crash, something of that sort. I'm forgetting the name. I'm very bad at book names. I think Rahman was here. No, Rahman is very good at remembering the names at the drop of a hat. I'm very, very bad. But then there's another very interesting book that I've read called More Money Than God. Uh, that's by I think an author called Sebastian. Uh, he's written. This is about the hedge fund industry,
Hmm.
globally, and that's why they call it More Money Than God, because how the fuck you money is made in the markets, and how big sizes are moving. Market wizards books are always good. I One thing that I like to do is I always listen and uh, read about how discretionary traders are trading, and I'll tell you, that's, I mean, it's not like a secret, but that's my approach. And the reason being, and maybe it might be very peculiar to my situation. I'm in New York, right? I don't get to observe the live market, Indian market. So, I come from a background wherein I used to watch the market and form a lot of hypotheses. Uh, but now I can't do that. I don't, I mean, replay is not the same thing, because when live market happens, it teaches you patience to sit in the in the front of that fucking screen for 6 hours to just bloody stare at it, right? As a back simulation is not the same thing, because you're just gonna forward it. So, and that's why what I do is I follow and listen into a lot of discretionary traders, what they are talking about, how they are observing the market. And sometimes every now and then you pick these nuggets, which then help you create your own hypothesis that you think you can systemize or can tweak your strategies and so on and so forth. So, the books also kind of give you that kind of the hedge fund, the market wizard books also kind of give you that knowledge that how these traders used to trade. I don't think they have written a book on algo traders. So hedge fund market wizards, the market wizards books are all good. Uh, and then on systematic trading, there are a bunch of them. There are books by Ernie Chan. There are books. There's a book by Rob Carver. Uh, for general trading, there's a book by Augustine, which is called. Uh, hey, I forgot that book. Oh, anyways, the laws of trading. So it's a book about the first principles that we earlier talked about. And how they apply to life. So it just brings a wholesome picture to this endeavor. Uh, and then there are a bunch of systematic trading books, depending on what you want to read. Like there are books on momentum trading, there are books on uh, options trading, some garbage, some useful. I have a thread. I'll try to dig it up and share
Yeah,
it with
man,
people.
definitely share that thread with us, and we'll tweet it on our end as well. Um, so the last, sort of like towards the end of this, we'll take some questions, depending
Mhm.
on how much time you're available for. I wanted to just talk about that once a strategy has passed through your filters, your litmus tests, you found a strategy that you like, and you decide that, hey, I want to dedicate a certain proportion of my capital to this one particular strategy. So the two-part question here is, how do you decide that proportion? And then the second question is, once you've decided that proportion of how much of your capital you're going to allocate to that particular strategy, the next step is, how long does that happen, before or after you do some kind of an outsample paper trade, or some sort, or do you actually even do that?
Yeah, so paper trading is by default necessary before anything goes out in live market. Even after the backtest ends, uh, at least a few months of paper trading is taken place. I've done that. I think my strategy called Quick Singles is a public demonstration of how I took a strategy from backtest to paper trade uh, to live market. Now, the way I like to do paper trade is I will, once it has passed all my backtest parameters, I will put it on paper trade just to feel how the strategy is doing, let's say for 2 weeks or 3 weeks, whatever the holding period, or how many trades I can get. And soon after, I will put one lot on it. And that's what I did with quick singles actually. And actually, I retweeted a few days ago. Sagar Parikh actually subtweeted on one of my old posts, which made me refresh the memory of how I made some really stupid errors on a quick singles option trading strategy and how I fixed them. And the reason I was able to fix them was because I was trading one lot on them. This is my personal opinion, and please don't do it, just because I am doing it, because I understand the risk I'm taking in a given strategy. Be it one lot, I have the capacity and the capital to absorb losses of it, even if it burns down in next 2 months. I'm trying to test out the markets, how the markets behave, how the strategy behaves with my live trading. So my process is to backtest a strategy, put it on a paper trade for a while. Now there is no fixed no fixed rule, right? It depends if it's an intraday strategy, maximum 2 to 4 weeks will give you enough trades to test it out. If it's something positional which holds for 2 4 days, then you might want to wait out for 6 weeks, right? So and you may just want to start out with one lot if you're more satisfied with your back test and simulation. So with this strategy, I back tested it. I think I had completed the back testing in January, February. Then from February to May, I ran it on a paper trading. Like, I did not live trade it. I did not do. I might be saying the months wrong, but for some period I ran it on paper, and then I started trading live with one lot. And then it was during this one lot trading phase. So, the interesting thing is, on paper trading, it did not pain me. Like, my errors were on paper, so it did not pinch me, it did not hurt me to fix those, right? But as soon as I start trading it with one lot, and that's what I do with this gap trading thing as well, which I've been doing for the last few weeks. I trade them with one lot. There was somebody who told me, "Hey, one lot trader, kya ukhad lega?" I was like, "ठीक है, you don't understand the reason I'm doing this. I'm trying to get feedback from the market from my premise, right?" So I will trade it with one lot, and that's where it hurted me. The mistake started hurting me very quickly. I was lucky that whatever the mistake was, what got uncovered really, really quickly in the one lot phase. And ideally I would run it for some time in one lot phase, so to say, and then I will bring it on in my full size, or in the in a bigger set of portfolio, with all the different considerations of how to wait, what the strategy is. So there's no fixed answer. Like, if it's replacing, let's say if I'm trying to find out a new way to do momentum, sounds stupid, but maybe, then it's a replacement. So whatever the momentum strategy had the weight, I'm going to add that in. This one replaces it. Or if I'm trying to say, oh, this is a new alpha which goes into my momentum bucket, now I had 5 strategies running in it. So whatever the capital allocation was, I'm now going to make it 6 of them. So change my allocation to each strategy. So it really, really depends how it goes in. But I am never thinking about a single strategy. I'm always thinking about a portfolio of strategies, if that helps.
Just a follow-up question around that. Like, how do you determine the allocation across your buckets then?
यार उसका आंसर very simple नहीं है. Like, I'll try it, and let's say, okay, so let's say you're running AlgoTest strategies, which are primarily short strategies, right?
Yeah.
So let's say the first question is, how much leverage you want to take on your account, right? It's intraday. You run some simulations. You know that, okay, if the market goes down by this much, I'm gonna put some losses and whatever, right? So you put this up. Now, the other thing, let's say you build up 5 strategies on AlgoTest. One thing I would want to do is I want to check out their correlations. So if 3 of the strategies are high correlated, then I would probably weigh them down. Even if I'm like trading 10 lots, right? So I will probably trade 5 each on these, because they are technically 15 lots on a correlated set of strategies, but I'm just still diversifying. And then there are 2 of the other ones which are low correlated. So I will trade, let's say, 10 lots each. So, that's just example of saying you have a total of 25, 35 lots. I'm just, putting it out. Don't, pull me on those numbers. But you've tried to diversify risk in not only intra strategy, but, on correlations, on the bucketing. Like, you could do this on option buying and option selling as well. You can say, okay, I have X to Y ratio of my bias to sells, right? I want my strategy to be skewed towards a non-directional strategy, or I want my book to be completely non-directional, and I equally weigh all of them. So there is no prescribed formula and answer to it, and I wish I was able to give it, but there is none. It's just there's a lot more analysis that goes behind it.
बिल्कुल ठीक है. Okay, we want to take some questions. We have a few people who are requesting to speak, so I'm just gonna whitelist you guys. Unmute yourself and ask your question.
Hi, Ankit. It's Ankit here.
Oh, sorry.
Hey.
Hi. So my question was that max drawdown is not, written on stone, unfortunately. So what should be the position sizing approach in trading? Because max drawdown is unknown to everyone, each one of us.
Right. So I think that's where the Monte Carlo helps you a bit. So position sizing is a function of the leverage you take And by controlling the leverage, you can change the drawdown that you're going to face, right? So even if you, let's say you backtest the strategy with 20% drawdown, and your Monte Carlo says, oh, there's a potential of up to 30%. You're not comfortable with 30%, you want to scale it down. So if I were in your case and I'm trading only this strategy, I will say, I will price it on that Monte Carlo and say, at what pain point on my portfolio will this Monte Carlo upper limit will hurt me? And I will try to position it size that down in that way, and then think whether it makes sense for me to trade this or not. Uh, so I think the unknown part of the future drawdown is where the Monte Carlo really helps, and you can piggyback on that number to an extent on a single strategy basis.
Sure. How is my voice? My voice good? Sometimes it's not very good.
We can
Yes,
hear you,
yes,
sir.
we can hear you very well, sir.
Great. Hi, Chintan. Hey, Raghav. Hi, Ankit. So you talked about this thing that, if you're not happy with the X percentage of drawdown, increase the capital and, take the drawdown lower. This is something I've been myself been struggling for some time. Like, how do you decide what is the right allocation of capital to something? Like, draw down to 5%, that is 20x of the capital of that, or margin plus 2x of MDD. There are so many people try different ways. So I want to know what are the different ways that you try to, say this is the allocated capital to this, and I'm going to measure my returns and rewards based on this. So, what are the different options do you follow on that?
Yeah, so it's a very good question, and you're right. I know the way a lot of people do go about position sizing is they will calculate their drawdown, absolute rupee drawdown, and they will add a 2x buffer to that. So let's say if your rupee drawdown was 1 lakh, you add 2 lakh, you say 2 lakh rupees as your drawdown cushion, or whatever the number might be, and then the margin required to put on this trade, let's say it's a spread trade or options trade, whatever, and there's 2 lakhs of it because it's a hedge trade. So they say, okay, we can trade this with 5 lakhs. Now that's one way, and very legitimate way. Just keep in mind that that doesn't apply in all situations. Like if I'm trading overnight futures and doing something like that, I'm letting the overnight risk creep in without realizing it. So I'll try to give you an example. Let's say I'm trading only Bank Nifty futures, and let's say my drawdown in the back test were 2 lakh rupees. Okay. Now I say, okay, 2 lakh rupees of back test, 2 lakh drawdown in the back test, I'm going to double it up, 4 lakhs. And one lot of Bank Nifty costs about margins about 1.6, 1.8. So let's say 2 more lakhs. So 4 lakhs of drawdown cushion and 2 lakhs of margin brings my capital to 6 lakh rupees. Now, if I trade one lot Bank Nifty with 6 lakh rupees, I am trading on roughly 1.2x leverage, which is fairly manageable, right? 1.2x. How do I say 1.2x? Your capital is 6 lakhs. You are buying one lot or selling one lot, and one lot of Bank Nifty is roughly 8.5, 9 lakhs, right? So 9 lakhs is 1.5 times of the margin or money you're keeping, 6 lakhs. And that's a very legitimate way of bringing it up, right? The other way is like what I try to do is one of the systems I first started Dynamic, it had a 10 lakh. So I said, okay, my portfolio size is 10 lakhs. Now with this portfolio size, what all can I trade? So, it doesn't fuck it up and sometimes hedges my or diversifies my risk. So I started trading a trend following model, which is, slightly on the higher risk. So I take 2x leverage on that. Technically, I trade one Nifty, one Bank Nifty on 10 lakhs capital, and I take overnight risk. So if market gaps down by 5%, I'm going to lose 10%. But that's okay. That's my risk parameterization. And then I say, okay, now that I'm using that, can I put some sort of diversification which can minimize this variance? So can I put, let's say, an option buying hedging strategy, which will minimize my overnight risk so that and give me some alpha, which I can trade on the same capital. So there are hundreds of ways to do it, but the way I at least started is I said, okay, I have an account size. What can I trade on that, and what kind of strategy, what kind of method I want to trade on that? And I still do that. I create portfolios with a target capital allocation in mind. Like, my current research is trying to create something for 10 CR allocation. That, okay, you have a 10 CR account. What's the best way, most diversified way to manage risk and generate returns on this account, given that you have this capital? Rather than saying, oh, this is the strategy and I will trade this with 2 lakhs. I go the other way. I say the account size is given. Let me see what all I can do with it. So I hope that answers your question.
Yeah, okay. So, sir, Ankit, sir, apart from this drawdown, we can apply the Monte Carlo simulation based on drawdown. So, apart from that, can we apply based on the uh, price action? I mean, let's say Nifty can go up to 18,000 or 18,500 or 17,000. So, can we have those thousand, maybe thousand combination, and then based on that we can perform the backtest?
Yeah,
Or
absolutely. I think, that's, so Monte Carlo is just a starting point. And like I said, one of the assumptions is you're saying कि जो P&L generate हुआ होगा वो exactly
uh,
वही trades हुए होंगे. But you
right,
can also say, okay, during this period, if Nifty, I traded at 16,000, or let's say I'm going momentum or like a directional trade, I bought at 16,000 or I shorted Nifty at 16,000 and I exited at, let's say, 16,200, right? But what if there was a stress in the market and next day market 17,000 खुला होता? तो मेरा loss क्या हुआ होता? And that's why, the leverage understanding is important. Like I said earlier, मैं 10 lakhs rupees के लिए 1 lot 50, 1 lot bank nifty trade करता हूँ. So I'm kind
Mhm.
of trying to say it's 2x leverage. Agar market opens at circuit next day, which is 10% in index, I'm going to lose 20%. That's the overnight risk I'm taking. Now, I'm not saying, please, it's my personal money. I can do whatever I want with it. I would
Right,
not suggest any newbie to start with that, but that's just a way to look at it.
yeah,
And then you can do the same kind of analysis. It's just that your Monte Carlo has to be more not convoluted. It has to be more evolved. You'll have to build out it in a certain fashion, but it's a very legitimate approach that you're trying to imply here.
Let me know whenever you get tired, man. We can keep going on and on. We have a
No,
list of
I think
speakers.
whatever the couple of more requests we have, maybe in 10 minutes we can wrap up either with pending questions or whatever. Like next 10 minutes, I think we can. 10, 15 minutes, I'm fine.
Sounds good.
Uh,
Sounds good.
Wannabe trader, you wanna go next?
Sure. Hi, Ankit. If you can hear me, I have a
Yeah.
lot of questions. Sorry, we don't have to go through all of them. Uh, and before questions, great choice on Eric Clapton on Wonderful Tonight.
Yeah, it's
Yeah,
one
one
of
of my
my favorite
favorites.
songs.
Yep.
Yeah,
It really sets the mood for getting you in the groove when you're trying to focus and work. So, yeah.
absolutely.
Question. How does macro affect your strategies? And like uh, and the news events like the day-to-day volatility, say today CPI numbers came out, markets were haywire even before the markets opened, right? Like crypto was open 24/7 and things were haywire earlier in the day. So how do you account for such short bursts of volatility?
Yeah, so I think what one needs to understand is, and again, it will come to the risk perspective. What kind of risk is your strategy taking, and what kind of leverage you are taking, right?
Okay.
I am usually not perturbed by any of these, because I said I trade on 2x. I know next whatever happens overnight in the market, next morning Nifty will open at certain percentage up and down, and then depending on whether I was long or short overnight, I will make or lose some sort of money, and I've digested the fact that how I'm going to deal with it if it happens, right? So I don't. My current trading strategies are not. I mean, they are affected. Like, of course, CPI comes good or bad, the market goes one direction. Nifty or Bank Nifty can completely screw up my position tomorrow morning. But then that's part and parcel of the game. There is no way you can diversify it out or you can leave it out that you're completely agnostic. The only way you can agnostic is if I change my style. So one of the research that I'm now trying to do is to change this dynamic from a futures long position to long options buying or through a spreads trade. And I tweeted about it. There were very nice ideas given by some of my people I look up to in option space. Prashant is here, the best example of that. And I'm trying to research it on. So that's like, and probably that will answer one of the Raghav's earlier question, that what do you do? How do you bring strategies or whatever? So this is a perfect example. I used to, for last 1.5 quarter to 2 years, I've traded dynamic and futures options, futures trend following model, taking this sort of risk. Now I want to cap it. I want to change it so that I'm protected against black swan. But the moment I try to do that, I'm, the future, the good thing with futures is no time decay, nothing. It's pure delta move. But now when I start trading with options, I'm letting volatility and, so many other aspects, expiry, close to expiry, further expiry, blah, 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 into play. So I need to completely look at it in a very holistic manner to see what I'm trying to do, does it make sense or not? Like, it's not just a simple backtest. It's the same set of rules, which I will probably execute in a different manner. So, to your answer, to your question, let's say if I'm worried about macro events overnight, I can try and change my style. I can pause a strategy or do whatever I want. But there's no deterministic way of saying that, hey, this is how it impacts. I hope that answers the question. Oh, I don't see him.
Lal, you can go next.
Ankit ji, good evening.
Hey, how are you?
Yeah, thanks for giving me an opportunity to speak. My question is a little bit off Monte Carlo simulation. It's about non-directional strategy. So, if you had to deploy a non-directional strategy, how would you go about it, and how would you control overnight risk? Would you prefer a hedged non-directional strategy or just naked non-directional strategies?
पहली बात ना, तो मैं अपनी फितरत से नॉन डायरेक्शनल नहीं हूँ. मेरे को नींद नहीं आती अगर मार्केट में ट्रेंड आ जाए और मैंने उसमें पैसे नहीं बनाए. तो दैट्स जस्ट knowing yourself is also equally important. So मेरा most of the research somehow, and maybe this is a shortcoming of mine, that I'm certain biased towards directional systems, is I'm that guy who would want to be riding the trend. And non-directional रहेगा तो I manage my risk, and market remains in a chop. I will bleed, but then I will try to make money. But if you give this as a research problem to me, that, hey Ankit, how would you think about a non-directional strategy, and especially one which is holding risk overnight? So let's think about the premise. Your premise is the reason you would want to hold overnight risk on non-directional is, and if it's purely non-directional, I'm assuming, so when it's non-directional, you're trying to nullify your delta risk, basically the risk of market moving in one direction, and you're probably trying to harvest this volatility, overnight risk premia, or whatever the equity risk premia in some fashion. So you have to be clean with why you're trying to trade this. If you're trying to trade this with these premises, I want to be delta neutral. If you want to be delta neutral, then yes, you want to be, let's say short straddle is kind of a delta neutral. But then if you're putting this risk on only for an overnight, let's say equity risk premia, then you want to be hedged to an extent, because the tail events will always take place. So I started off as a trader who would take more risk. As the size has grown and my algos are now trading on different size capitals, I've come to the camp wherein the overnight risk has to be capped. There was this, what principle is called, uh, liar's poker. I think there's a book by that name which kind of says, even if there's a 5% or 2% chance of something fucking up in your system, in your life, it will probably come around. Somebody will fuck it up. You don't want to be on that side, so you want to be hedged. So long answer, trying to make it short, I would recommend trading it in a hedged fashion. How you hedge it is a completely different ballgame.
I think Prashantji, Ankit, you mentioned him. He's here as a speaker now, so maybe we can have him say something.
Hey, thanks, Raghav. I have two questions for Ankit.
अरे आपका कैसे क्वेश्चन आंसर करूंगा, क्या बोल रहे हो आप?
Well, no. For the first question, the first question is super important. I want to know, when do you get sleep? Do you even sleep at all? Because I know you trade expiry, and you're probably on your day, heading to your day job.
Yeah, so I don't trade expiry as such, but yeah, I've been, ever since I've started building out this Decibel, my sleep cycle has been fucked up. But that's the price I'm paying for chasing something that I really want to build. This is really a personal thought I'm sharing, that uh, I sleep for few hours, and then the days when I trade, take an open market gap trade, the sleep gets curtailed. So what I end up happening is, I will sleep less at the night, and then I will come home in the evening, let's say after my work or whatever the situation might be, and sleep. It's not the most healthy way, but I'm trying to. It's one of the agenda items for the next year is to get more of my sleep back, and build out things which will help me do that. But I know you've
Superb,
asked me this
superb.
in the past,
All
and
the more
people have
power
asked
to
me
you.
this.
All the more power to you. Okay, so the other question is more on topic with MC simulations. I was just wondering. I know you run different types of strategies. Some of them are positively skewed. Some of them might be negatively skewed. Do you treat MC simulations for these two different types of strategies differently? Um and I
Yes.
hope you get my question.
Yeah. Yes. 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 Yes.
I mean, I can
And
elaborate
this.
the question a little bit more for the
No, no,
audience,
I
but
get it.
yeah.
Yeah. Yeah. If you want for the audience, you can.
No, go ahead. Please go ahead.
No, no, do it for me, sir. Do it for me. If you don't want to do it for the audience, do it for me.
No, no. My doubt is that when you do MC simulations for strategies that have more winners than losers versus conversely for other strategies that have smaller amount of winners, they might be breakout and trend following strategies. Then you have a lot more losers, and then when you're doing your MC simulation of rearranging trades and so on, these two groups can behave very differently, and things like your 95 percentile. Max drawdowns can be very different from these two groups. So how do you deal with that?
Yeah. So, um, the public article that I wrote is just the starting stepping point of it. There's more to it, right? So, and yes, you have to have different simulations because if I try to take a step back, I'm saying there are two different processes, right? One is this giving a negative skew. So, negative skew is like these option selling strategies, which will have frequent small winners and then maybe one large loser or few large losers. Or then you have a positive skew strategy wherein you have these frequent small losses or small winners, but then like a very high win rate, like a momentum one, right? So these are very different. The characteristics itself, the processes which will produce these output have different characteristics. So one of the assumptions of the Monte Carlo simulation, or when you're trying to run it across different processes, is that they ideally they should have similar distribution. Otherwise, you are running one on apples and one on oranges, right? So it's like slightly more advanced concept. So uh, yes, you should run them separately, so much so that you can actually go further deep. So within your set of strategies, you can put different buckets. Like, for example, I was talking about expiry earlier, that if you believe your strategy has higher win rates on expiry, then you create a bucket of your expiry trades and then one bucket of non-expiry trades and then shuffle those around, right? So that is essentially giving you 4 days of PNL followed by 1 day of PNL, but then you can code it up so that it gives you that output that you're looking for. Or you can trade it, you can bucket it on DTE. So there is, I guess what I'm trying to say here is there is a lot more simulations that you can run, and they should be separate based on the style or the harvesting you're trying to do. And then on top of that, you can also put a simulation on the portfolio level. So like I said, I start with the premise that I have a capital size of 10 lakhs, 20 lakhs, whatever it might be. I build these strategies, they're running on it. Then I run a simulation on that because my hypothesis there is these positive and negative skew strategies being traded on the same account will have their own correlations, and probably this simulation on the portfolio level might yield something which the micro level cannot. So I mean, if somebody wants to go fancy, you can look at correlations and then start stressing those correlations as well, that on a typical basis your correlation over the last 20 days is 0.5, but what if it changes, or what if the average goes up? So there is, it's a rabbit hole to go into. I like to stop it at having different simulations for different styles and then a portfolio simulation.
And just very quickly, you mentioned a few minutes back that you take, in order to size, you take 2 times your observed or realized max drawdown. When you run your strategies through MC simulations, then how does this 2x of max drawdown observed compare with your 95 percentile max drawdown typically?
No, no, no. So they are very different. Look, the 2x drawdown was the comparison that goes, which is popular in FinTwit, that you have the backtest number, and then when do you stop the strategy is when you hit the 2x. Typically, the article that I wrote, actually, it showed that for quick singles, for example, my simulation showed that even 1.5x is the 95 percentile. So if it, or maybe 2.5x it was the other way around, I think. So even if it hits 2x, I will not stop it, because in the simulation it showed, it can easily go to 2.5x, right? And on the other ones, usually I have some strategies for which this 2x comes fairly close. Like if I have to, gun to my head, answer somebody in 10 seconds or 2 seconds, I will say 2x, because for a large amount of, or for large size of strategies, it may be very well true. And that's the funny thing about this markets is this popular parlance is not inaccurate. It's just that it is not very statistically or scientifically backed, and I would want to dig deeper. But it's not a bad metric at all, and a lot of the strategies will fit into that that boundary, so to say.
Thank you. Thank you so much.
Thank you, Prashant ji. Quant Alchemist is next.
Hello, good evening, everyone. Hi, Ankit.
Hey.
Yes. So I am relatively new to kind of algo trading, right? And I've been trying, and I took one of my simpler strategies live recently, and I didn't do any Monte Carlo simulation of sorts. I'm kind of new, and there's still a lot to learn and a lot to experiment. So a lot of I had a few questions. So number one is, a lot of newcomers into the algo field, they give a lot of importance to Sharpe ratio rather than the having a look at the equity curve. So they try to curve fit and the Sharpe balloons to extremely high levels. So what would you advise on, what is your opinion on that?
My advice to those guys, or my advice to somebody who wants to make money?
No.
So, so I've seen people doing all this curve fitting and then creating a PDF and selling it because it sells well. Like if I show you a strategy which is 25 sharp, you will buy it. You will pay me money to know the strategy, right? But then, like you rightly identified, it's very well curve fit. And Raghav and I were chatting this morning itself that how people curve fit, and then in 2 months they scratch their heads, ki, Sala, why did this break? Because you spend all the time in optimizing to fitting. And this was one of the points I made earlier. A backtest is so much dependent on the window of the data that you used, like how much data did you use, and the rolling size, the 1 year, 2 year, whatever might be, kiss period may you have used the data, is that your backtest, there's a common saying says you can torture the data enough to reveal it whatever you want it to say. That's the thing with data, and that's the thing with backtesting strategies. And when people like Raghav build this AlgoTest kind of a platform, you can run all these curve fits all throughout the fucking day and come up with the most beautiful looking outputs. That doesn't mean it's gonna stick around that way. So I would say talk around to people who are actually trading these strategies live and think what kind of sharps do they generate. And are these, one thing I learned as a market maker is, if I don't know what the fair price is, I will just assume whatever the last traded price is the right price. If I don't have any opinion, and we call them in the risk, if I don't have any priors, I will just say whatever, if it traded 100 rupees, I will assume that's the right price. So if you don't know, then I will say just, look around people, see what kind of sharps they are trading, and just say, okay, if average of 5 people or 10 people are trading sharp ratios of between 1 and 1.2, then I will say I'm comfortable trading between 0.8 to 1.4. And that's what I would like to generate. So don't go by people who curve fit, go by people who actually trade their own money. And let me tell you, sharps of 25 are probably very hard to achieve even in high frequency trading, wherein you practically don't lose in a single day. I mean, at least the big funds. Even then, it's very hard to achieve sharp 25, let alone in a portfolio of strategies which are intraday trading this, 920 straddle version. So don't go by that. Um, there used to be a cold drink in India called Mountain Dew. Dikhawe pe mat jao, apni akal lagao, sort of a thing. That's what I would suggest. And Raghav, I think let's just take one last question. My throat is like, now giving up.
Yes, yes, for sure. Anudeep is next, and he's the last one. Yeah.
Yeah, yeah. Hello, hi everyone. Thank you for the opportunity. So actually, I'm not aware of the Monte Carlo simulation, so I kind of new to it, and I'm trying to understand things here. I got a lot of insights today with the discussion. I'm really feeling great, and also which make me to raise a question. Like, see, my system is on backtest is different, like giving different results. So, but the system that I have that I'm running is running in different, like completely, not completely, like some part of better than the backtest result. So, will it be like uh, okay to execute, or do I need to look into the system again? I'm thinking about that. I have a question on that. Can you clarify me on that?
Sorry, I missed. I think your voice broke in between for me. Could you repeat? What's
Okay.
the question?
Yeah. Question is, I'm seeing I have a system which I built. So the backtest, the strategy backtest results is different. Different means, suppose if you take 1 month comparison, the backtest and the live trades. So I'm getting the better results on top of the what backtest is having. Suppose there is take one lot, it is showing as a 5,000 profit, but on live it is around 15K of profit. So such variations, how can we take that strategy?
Yeah. So, and I'm assuming you backtested this in one of the platforms. You did not really build your own code and
Yeah, true. Yeah,
okay.
I
So,
I did in AlgoTest.
so
Yeah.
you should understand what are the assumptions of a backtest. Most of the backtest, if I'm not wrong, backup is also on a there's a 1 minute data. 1 minute data is like a candle close data, whereas in live market there's no candle. You're getting constantly prices or last traded prices. So you should try and search and read upon what is the tick data and why would there are a lot of questions people have asked in the past that, hi, my stop loss got hit, I don't see that price on a chart. And the answer is the market has ticks which may or may not be captured in this historical data. So your strategy performance, which is based on this candle close data, which is only 4 data points, open, high, low, close of a given time frame. The live market has much more ticks, much more data flowing through. So when you put a stop loss, let's say you sold something for 200 rupees and you put like a 20% stop loss at 240, it may happen that the intra candle, a tick will come and it'll hit your stop loss and market will execute it, whereas it may or may not get captured in the candle. That's one example. The other example is the entry point. So backtest will assume where the candle closed, you were able to enter. That is rarely, if ever, true. You will likely be able to enter at a different price, which means your stop loss or entry exit itself will also be different. So there's, the live trading has so much dynamism in it that it's fairly easy to have a day-to-day variation between backtest and live. What's important though is to understand over a given period, let's say a 3 month period or a 6 month period, at that level there should not be much variations overall. Like you can understand some, expect some kind of variance or standard deviation, but that's where it should not be that one thing is going super off the cliff, be it positively or negatively, because that means you have not really accounted for the right set of risks in your back test. But it's you will very rare, like I see all these screenshots on Twitter which say, oh, my backtest says 4,510 rupees and my live is 4,490 rupees. So I'm, beautiful. But that's just one random lucky example for the day. You have to look at from the perspective of if 1,000, 2,000, 5,000 people traded the exact same trades and 2 got the same PNL, that's expected out of just the noise in the market, right? So that doesn't say that the backtest is right or wrong. It's just the feature of the market, right? I hope I didn't bore you with that, but yeah.
Yeah, it's not. Yeah. So
Awesome, man,
Yeah.
Ankit. So thanks for this, dude. I think we need to get you to join one of our Telegram groups where we are doing customer support, and we have to explain this to users. I think you do a much better job than we do in trying to explain this to our users.
Definitely.
And we are sort of to blame in this as well, because sometimes what happens is, after we've received a lot of hate around, hey, my backtest result is not matching my live result, sometimes the backtest result comes close, like a particular day's backtest result comes close to live result, and then we also get fall into that fallacy of showing people, see match to kar raha hai yaar, but
Yeah,
that's
I mean,
obviously
Raghav, you're running a service, right? I don't blame you. I'm just trying to, draw that out, that for people who think that my backtest and live should match exactly or very close, those are some kind of unrealistic expectations on a day-to-day basis. Think of it on a more, an aggregate basis is what they should look at rather than on a trade basis.
Yeah, that's exactly right. And I think what
Correct.
we're going to do is we're going to use this like last 2 minutes that you actually took to answer this question. We're going to save this and we're going to share this in our Telegram group every time somebody asks us this question. So we're going to use this for that. Thanks for this.
I'll expect a royalty, Raghav. Every time you share it, I'll charge you, I don't know, $0.25, $0.25, whatever. Anyways, just kidding.
Free options backtesting tha yaar hamara abhi bhi. We try like cheaper than anybody else, and we're trying to keep it super cheap. So free, I'm happy to give you part of that. Anyway, dude,
But 25 cents a week, like 25 free backtest a week. I think that should
Oh,
be
come
good.
on. That's not my worth. Come on. Itna to, anyways, chodo. This will completely get derailed.
Yeah, we'll continue this when we actually meet. Whenever you're in India next, or if we end up moving to New York for some. When are you coming to India? We'll take this next time.
Yeah.
Okay, thanks a lot, Ankit. Thanks so much for
Thank you, everyone.
being here, spending time. Thanks everybody else for showing up, asking meaningful questions. We are actually going to also post this on YouTube. There's a lot of nuggets. You guys should come back and listen to Ankit again. I'm certainly going to go through this conversation again. Thanks again, bro. Thanks everybody
So, Raghav,
for coming.
before we end, just one closing thought from my side.
Yeah.
So thanks for, of course, inviting me and having me speak at this. But the platform that you've built is, of course, helping out a lot of people. And I see there's earnest effort from your team to kind of answer the questions and bringing a varied speaker set to the audience. So phenomenal work being done by you guys, and special thanks to AP, because I got to know that he was the one who wrote that bio, or what you shared. So personal thanks for that. I really liked it. I told Raghav I'm going to use this as well.
There was no lie at all, sir. Thanks for coming on.
So all the more power and luck to you. I think the Indian industry needs such platforms to help people do quickly turn around some ideas. And I hope you grow your offerings to more things as you grow. So all the best. Good luck.
Awesome. Thanks a lot, brother.
Thank you. Thanks.
Coming
Okay.
from you. Appreciate it very much. Chalo. Thanks a lot, guys.
Everyone.
Thanks for showing
Thank you,
up.
sir. Take care.
Have a good night, everybody.
Good night, everyone.